There's a company called Horizon Lines. So I short a lot of that company. One day I woke up, the stock went up like 23% or something. One night, the CIO asked me, "Hey Johnson, you sure about this short? It's getting a little bit painful." In China, they manage the risks in a different way. So the exchange know the position of every trader. The exchange also has the authority to call individual trader and say, "Hey, you have too much position. You have to close it."
Okay, they close the position?
Oh yeah, their instruction, not a recommendation.
Let's say after this episode,
Yeah.
some board member at Maersk, MSC, COSCO, they've watched it. They say, this is a great idea. Johnson, that's a great idea. What's the next action they need to do? Welcome to another episode of the Schelling Point. Today, it's my pleasure to welcome my guest, Johnson Leung. So Johnson is an investor. He's a co-founder of a company called Linerlyitica, which provides analytics for the shipping industry, for the freight rates. And also, more recently, he's been focusing on very interesting subject of freight futures. So it's my pleasure to welcome you today, Johnson.
Thank you. Thank you for having me.
Can you quickly introduce yourself in terms of your career, your background? Because I think you have probably the most interesting background of all the people we interacted with so far.
Yeah, I have always been in shipping. So I started my career in Maersk as an apprentice. So learn about the liner trade from different angles, line management, logistics, and then e-commerce as well. So about 7 years.
7 years.
Yeah, 7 years.
In Hong Kong or
Well, it started in Hong Kong, and then they sent me to Brazil, and then from Brazil to Copenhagen.
Headquarters.
Head office. And then I spent some time in Portugal as well before I left for MBA studies. Cool. So that's like my first 10 years of my career is in shipping. Other than Maersk, I worked a couple of years in Hutchison Port. Did the Port of Soha project. I was a project manager, but of course under the guidance of the director at the time. So who's my boss, Raymond Law. So we did the Port of Soha concession. This first 10 years of my career, so really just pure, just like any other shipping manager. And then the second 10 years in the finance market. So just out of the blue, I get a phone call from JP Morgan. They want an analyst, want someone to fill the role as an equity analyst. So that has they also want a candidate that has some actual shipping background.
So when was that? When they were hiring for this role?
That was 2007. So at the peak
before the GFC.
Yeah, before GFC, and also at the peak of at that time, that was called super cycle, of course. That super cycle.
Yeah.
It's not comparing to the super cycle that we know the last 5 years, right? So, they look for someone in my background, and at the time, I don't know you recall, year 2006, that was also when Hutchison Port started to exit the port business.
Yes,
it's not now. So back then they already sold 20% of Singapore, right? My role back then in Hutchison was investment manager to look for to acquire port concession. And then I found okay, maybe I will be redundant soon because they're not looking for any more port to acquire. So it's just it's big change. But I have no idea about what I was getting into in JP Morgan. But then at the beginning, I do not know what's the research. Active research, right? I think for many people in shipping, they would not know what active research is. So if you tell them that the role as an analyst, they will think about, you're just a supporting role and that kind of thing. Without knowing that research in the finance world is basically is a career track on its own. And then,
you go from there, you can go to hedge funds. You can become a portfolio manager in a hedge fund from research. People don't understand that.
Yeah, that's what happened. I joined JP Morgan, and then I learned about the capital market, the stock market. At that time, I cover all the Asian shipping stocks. So there was a time when the bank could still pay for a full-time headcount to just cover shipping stock. And that role no longer exists.
Yes.
Now you find that most of the analysts in the banks cover shipping. They usually also cover travel, hotel, so a bunch of different things because the shipping equity just shrank over the last 20 years. So, but that gave me the entrance to the capital markets. And then from JP Morgan, so then I get in touch with one of JP Morgan's clients, which is what I was servicing at the time, called Tufton Oceanic.
Okay.
So that their clients are very unique, so in the sense that they are a shipping specialist. So
it's a hedge fund. It's a long short hedge fund, or
a long short hedge fund that trades primarily stocks.
Stocks, okay.
But they also trade some commodity as a hedge.
Okay.
So they just think for their funds, most of their people are specialists in bulk and tankers. They want a container specialist.
Yeah, of course, very different market.
So as a containers at that time was also very good, right? In year 2008 and 9. So my time in JP Morgan was short, but I did very well in JP Morgan. So that was a big decision for me at the time to move from JP Morgan to join.
Were you VP, director at that time?
I joined JP Morgan as associate.
Oh, wow. Okay.
So very late in the career. So I joined them in 34 as associate, but I become a VP already the next year.
Yeah, of course.
So I had a good run in finance market. I become an MD in 4 years.
Oh, wow. Okay.
From associate to
That's
MD.
good. That's fast.
So I did well. And then every promotion happened in the jobs, not because I'm changing jobs.
Yeah, of course.
So I joined Tufton because I just thought in JP Morgan, I started to learn about the capital market. But I found that I won't really understand it until I take my own position.
Yeah, agree.
I actually traded. And the hedge funds, Tufton, so they keep assuring me, we'll give you money to run from day one. I did not know how much.
How big was the Tufton as a whole?
Yeah, Tufton, they get up to about a bit over 1 billion, and then eventually become a 1.7 billion US dollars.
For equity, it's not bad, especially in Asia. For equity, actually, it's okay. It's decent.
It is very big, actually, for hedge fund, because hedge fund usually, on leverage, they multiply it for a couple of times.
No, I was saying for equity size, actually, it's pretty decent for equity size. For fixed income, I think it would be considered small, but for equity, actually, it's good. It's good. It's very good,
And it's not only that, right? They are very soon in
just on shipping, yeah.
So the challenge, once I joined them, was actually deployment. Because there's not sufficient liquidity to take that much capital for the shipping equities. But from day one, they gave me basically, I think I started with 100 million on my book, and then with leverage becomes 100 and something, 200, right? But eventually they gave me 200 million because they keep having some incoming. So they were very successful. When I joined them, so in year 2008, most of the people make losses and they make 5% profit. And then
which is great.
Yeah,
everybody was losing money.
Because everyone lost like 30% in 08, and then they're up by 5%, so they become the star in the industry. So and then there's a lot of money coming into them. But we had a deployment challenge. So but in Tufton, that's really the first time I get in touch with trading futures. So because on my books, my focus in container liners. But I also take China COSCO, the Japanese shipping company. They also tanker and bulk. But since those are not my,
core position.
Not my core position. So I use a lot of the FFA to offload that kind of exposure. Like if I'm long in COSCO or the Japanese shipping company, then I will short some FFAs to take out the dry bulk exposure. No, I didn't trade FFA as a way to get the profit like alpha, but mostly as just a
beta hedge
to neutralize.
To hedge the beta.
Then I get involved with the entire FFA community. FFA, the way it trades back then is similar to what a CFFA being traded. CFFA is
actually, can you define FFA and CFFA?
FFA is the forward agreement. It's one type of a futures contract. So usually in finance, when we call futures, we typically talk about a very standardized contract and a product being traded digitally. just like with the experience of trading stocks. But FFA is something more tailor-made, so forward agreement. It may not be that standardized, and oftentimes you trade kind of OTC or you trade via a voice broker. So you don't have this automatic, because for trading stock, you put a buy, and then the system will automatically match you with a seller, so then get a trade execute. But FFA, you have to go via the broker, need to find a seller.
The lying things.
Yeah. I found out that in dry bulk and tanker industry, trading FFA is basically a part of the operation. In liners, we have the liner managers run the line, do pricing, and sometimes they also get in touch directly with the customers. But mainly what we call really manage the physical, the actual business. But in dry bulks, the chartering managers, on one hand, they will talk to like let's say I'm working for a ship owner, so I have the ship open, so I would talk to a cargo owner to fix the cargo. But at the same time, before I find a cargo owner, the same chartering manager may trade FFA to neutralize the position, to take out the uncertainty. So to them it's
very natural.
Very integrated, but in containers it's not the case, right? But that allowed me to see the ecosystem. I could imagine eventually other industries, when they have this kind of financial instrument, they also organize it very similar. The one who call pricing, not the finance manager,
of course,
the treasury manager. So it's actually the one who run business. So that person has a hunch about where the market's going, right? Not the finance manager. He's doing pricing every day. He knows that, okay, well, the future offer this price, the physical market offer this price, then which one he will take. So that kind of things, the operation manager actually is more familiar. But so that's my careers at the point as a hedge fund, and then I went back to the sell side. So I actually end my careers in the capital market in Jefferies. But then in Jefferies, things start to change, right? So other than shipping, I'm being forced to cover a lot of other things that I'm slightly less interested in. So that was my second, really the second 10 years of my careers in finance, and then the last 10 years was in entrepreneurial. Obviously, Linerlyitica is something that I feel like is much closer to me, because it's more about doing analytics. Even after I left the capital market, I traded the shipping stocks and all those things on my own book. And I also do research.
Explain a bit more what's Linerlytica. What does Linerlytica do?
Linerlytica, we actually manufacture our own data concerning all the demand and supply driver for container shipping. By driver, I mean the driver that move the freight rates. Because I trade the shipping stocks and also now to trade the fixed.
And this data, just to give people a sense, this data is coming from open source data, some AIS information. What kind of data do you use as a source?
Good questions. So we use the sailing schedule primarily. Whichever liner that have published a sailing schedule, we'll find way to the tickets maybe once a day or a couple times a week to stay updated. So we collect all the sailing schedules. From the sailing schedules, we know about the capacity deployment by different route. We also know who operate which ships. So know about operators. We also know if the ship is actually idle or being deployed or being active. So we extract a lot of information from the sailing schedule. It's not really about the schedule itself, but there's a lot of information that comes with it that's calculated by our own algo. But we also use AIS, as you mentioned. So the AIS, we use to a lesser extent, because AIS is not so forward-looking, right?
So AIS is the information that you have that the ship has to disclose with a transponder on the vessel to disclose where it is. It's open source, anyone can. But it's very, very messy, very dirty. You have to clean the AIs that to make it useful, right?
Yes. Other than building the algos in Alphaliner to manufacture our own data from this raw data, we actually a lot of efforts put in building I think in data science fields, what we call the matching table. So the matching tables are like different kind of spelling of Hong Kong, for example. Hong Kong port, someone spell as HK, someone spell as H dot K dot, someone's Hong Kong's no space in the between. So all different kind of spelling in the shipping world, port, even vessel names, all different kind of spelling for the same vessel.
I think a lot of people that don't realize a lot of time is just doing data janitorial work.
It is. So although you know it so well. So for data works, most of our data is generated automatically. So I would say 99 point something %. So all our products generate automatically. but that less than 1% that usually cannot be done or cannot be done correctly. So that needs some manual interference. So that's really taking a long time.
Yeah,
so my time and also my colleague Hua-Chu Tang's, he's super into it. Yeah, so that's our data products. And then most of our users are people from, they do ocean procurement in the liner shipping industry. So, but we also have 30% of the user now from the capital market.
Cool.
Hedge funds, traders, the trade futures or stocks.
Well, can you share the most interesting investment, short or long, or position that you've taken throughout those years?
Because the one that I really remember, there's a small position of this company called Horizon Line. So that is just like similar to Maxon today. So they do a lot of within US, what we call the arbitrage services. So, and that stocks, when I picked it up, the market cap of the stock is around like 200 million.
Oh, wow. Okay.
Yeah, it's not a big, but the reasons that other analysts that start to short it is because it has a depth of over 200 million. So when I picked it up, there's also a time when there's a couple of new shipping venture. They start a Trans-Pacific service. And then Horizon at the time also went from being just totally a domestic operator in the US. They also branched out the Trans-Pacific route. So I know that it's a very, very mean market, the Trans-Pacific.
Yeah.
I think anyone operated in it know that it's just very difficult to...
It's hard to make money in this one.
It looked like easier than Asia and Europe, but actually very difficult. Because you have to deal with so many different parties. I know that there's a very competitive market. So the new entrants, we have a tough time. So I short a lot of that company.
How much was the borrow?
So at some point we pay up to like 10%.
So so the borrow wasn't too bad. The borrow wasn't too bad. Usually, the borrow is the one that kills you, also. But the borrow is okay. 10% is okay.
It's not. But this is the first time I run a book, so I wasn't really thinking about liquidity.
Oh yeah.
So I basically the entire street. I told all the brokers, so you have inventory, give it to me.
Yeah.
I will short sell it. So I short sell it to a point. So I think my short position at one point nearly half is the market cap.
The other metric all short sellers needs to know: if I force you to close your position, how many days liquidity you have to take to close?
I wasn't thinking about it.
You didn't think about it.
I wasn't thinking about it. So one day I woke up. So I think that was a year 2009. The stock went up like 23% or something. Overnight. So
there's no reason.
You just have a good earning. Then I realized actually that position become very influential for the whole firm. I was running just a small part of it. So it's a 1.7 billion hedge fund. So
you have 200 million. So basically it's like 10% of the position. But this one is like.
but you have a lot of other colleagues as well. But if in 10% of the whole funds, there's one position that is be moving the fund's performance by a few percentage points in that month. So the CIO asked me, "Hey Johnson, you sure about this short? It's getting a little bit painful."
Yeah.
Because if that position start to affect the whole firm, so we get a management fee that's fixed regardless of performance. But the big chunk of the performance comes from the 20% share of the
performance fee.
And then my position start to take away the profit from all my other colleagues.
They're not big fan of you anymore suddenly.
So everyone else think, this year is supposed to be a good year. Oh, Jonathan did something that we may not have a profit this year.
So what did you do then? You close the position.
I said, so if everyone's not happy about it, so then let's see if we can unwind it a bit. So, of course, I still wasn't thinking about liquidity. And I found that in the process of unwinding, every day it went up 2-3%. So then I asked a trader. She's a very experienced trader from Credit Suisse. So then she turned around to me and said, "Hey, Johnson, you are trading even though I do very small amounts of pushing up the price." I said, "Then why do we push up the price?" Because you trade only 100,000 a day. And then you know how many days you trade.
That's okay.
Maybe that's not doable.
How did you close the position?
I cannot.
So then did you go bankrupt?
No, that's why I could not stay there in the hedge.
That's I see.
And then there also what made me so unpopular. So my colleague actually very cool. He said, "Hey, if that's fundamentally, so that's what you figure, and then you actually make sense, the case you present and look at the numbers, I think you may be right. So maybe you just stuck with it. So these 2 years, we just don't take bonus.
Wow.
He just told me that it's impossible to exit. But then you know how it is.
Of
right?
course.
It's just very uncomfortable. I said the whole time. And then I left after 2 years. I just, at one point, I also shot the hedging.
That turned out okay. That worked out.
Not during the time.
Not in time.
I remember that there's one of our brokers from Credit Suisse. He came to our office.
Yeah.
He said, "Hey, Jonathan, just don't do the kind of stuff that you do."
Yeah.
Everyone know the whole street know that you're holding a big position in this.
That's horrible.
That you cannot get out.
Yeah.
And people know it.
They will go push against you. They force you to cut your position.
Yeah, everyone will hold on to it. Know that you want to unwind.
What's the ending?
What's the ending? Were you right? I have a big loss in.
Did you go bankrupt or not in the end?
Oh yeah. So Horizon now, you never heard of the name now.
No. So you worked out. But did the Tufton keep the position or they unwind it?
They cannot unwind, so they get the benefit.
So they made the money in the end.
Yeah. So, but the irony of it is the bankruptcy happened, I think, about 1 month after I left.
Are you serious?
Yes. I think both shorts, even the hedging was eventually, but of course not that fast. But the Horizon, they went under in year 2011, just 1 month after I left. I get a phone call from Tufton and say, "Hey,
thank you, good job." Well done.
I mean, if they saw me, they would pat my back. So in the hindsight, I also think that might be the only way to do it. So if you have a strong position, you may as well do it in a way that you cannot get out. Otherwise,
no. So that was my problem on the trading floor, right?
Yeah.
So all the traders, we knew the type of risk you want to take, but the art is to figure out at which point risk management is gonna cut you. Because the guy will come look at you, we're all long. The market doesn't look so bad. We should cut. We should cut half, which I hate. Yeah. Either you cut everything, or you stick with the position, or you even double down. Sorry, but you never cut half, because cutting half. It's just like you feel good. No, you feel good. It's I one half is correct, but you actually didn't really make a decision. But that's the problem is when you have a liquid position, which the thing I used to quite liquid, it's really hard to hold on the position when it goes against you, because the temptation is to cut everything. You never make money this way. Yeah,
there's a lot of in trading, in financial market, like you point out this one. There's a lot of rule of thumb sometimes. The lesson learned of short is always a very risky position.
It's super difficult.
Because if you're a superstar, you make 100% of your position. So, but then if you're wrong, you can lose more.
Unlimited downside.
Yeah, unlimited, right? But long, that's why the market, in market, you should always be kind of long bias.
I think also it's a human nature.
Yeah.
It's a human nature to be very long and short. When you're the only guy short, when market goes up, everybody's super happy. You're the only one sad. When market goes down, you're the only one happy. Everybody's sad. So from an emotional perspective, it's really weird. It takes a special type of people to be able to do this, right? And it's not natural. Yeah.
Now, most of my positions actually I tend to be short. Though I don't appear like this, I have a very negative mindset. I think everything could easily go wrong.
Can you talk a bit another trade? Can you talk about long?
Yeah, the long side, I think one served me very well in COVID. When the whole world's talking about we may have a double dip in the GDP, so we already started Linerlyitica. So, and then from our data, we found this operator, Maxon, start to put in an extra load. Then we think, no, that doesn't make sense.
Yeah.
So if the world is running into recession then we should be all increase more idle. But we also see the idle capacity will coming back.
Really? So that was that was in April, May that you started to see
April, yeah. Then we start to go, I started to go long in a lot of cyclical, not just a container ships.
Wow.
So that was I mean financially that was the best year in my career.
Then which one did you go along the Maxim?
So
did you buy Zim?
No, the Zim wasn't listed yet.
It wasn't listed back. Okay.
Yeah. Okay. So, I did Maxon because Maxon.
Yep.
So the earnings. I did a lot of Maxon's call option at the time.
Oh, I see. Okay.
So because I just play on a bit more accurate earning estimate to play on that. When the result come out, I knew that there would be a reaction.
And which one besides Maxon? Which other container line did you use?
Usually it's China COSCO.
I use COSCO. Okay. You didn't play Maersk because I think the one you can play. I think Maersk, Zim.
Hapa could also.
Yeah.
But Hapa already a bit high at the time, I remember.
Okay.
Because they have some story about the two shareholders fighting for share.
Yeah. So, okay. It was too expensive already.
But COSCO was, they looked very depressed in March, April 2020. Maxon, there wasn't no one paying attention to it.
Yeah. I wish we knew each other back then, because I would have definitely go into that. Because I wasn't focused on that. I was looking at crypto. Let's talk about the futures. Okay. So I think before we talk about freight futures, I think it would be good for us to do a future one. So let's start from the beginning. What is a future contract?
Yeah, well, so most of our business transaction is actually a transaction to be settled in the future. So it's basically an agreement to be settled in the future on a price, and then the agreement itself also tradable.
It's on the specific underlying, the standardized also, right?
Yes, the underlyings are specifically, like the shipping slot usually is in physical market. I agree with you to ship a cargo 1 month, let's say in August, we are the shipment on a price. So in the physical markets, I'll give you that containers, and then I pay you, so and then you ship it for me. So the trades on the shipping slot, right? The shipping service. Yeah. Because now, I don't know, you know that we used to work on contract, but in shipping now we find it so difficult to agree on price. We actually move away from fixed price. We do contract for the index link, so there's no fixed price. But futures allow you to actually, without the cargo and some things,
and just to be clear, right? Forget about the freight futures. I think maybe it's too abstract. Some people who are not future. If you go more commodities, it's much clearer, right? Let's say iron ore futures, right? So it's a certain type of iron ore with a certain concentration of iron. It's a certain maturity, 3 months, 6 months, 12 months down the future. And then also, if there's a strike price, there's a level at which you're buying or selling. And then at maturity, there's a mechanism to settle what is the price of this commodity at that time, right? And then if you settle by cash, means I pay you the difference. If I buy, if it's above, I receive the difference. If it's lower, if I sell, I get the benefit. Or to physically settle, which means I give you the iron ore per the definition contract. That's the definition of future. Right?
Yeah. Now you talk about two kinds of settlement, right? So, the fiscal settlement and the financial settlement. So there's also a thing that, in shipping, we link on those ideas as well. So fair amount of our industry peers like to have a fiscal settlement. Right. So many of them, so you just get a price without getting me the slot. I still need to look for the slot. Yeah. So it doesn't solve my problem. Yeah. But they have to think about, they actually, in shipping, there are two problems. Yeah. One is securing the slot. Yes. Another one's agreeing on a price. Yes. So like when we talk about those future instrument, help you to actually lock in a price. Yeah. So,
but if you physically deliver here, that's an interesting question though. Yeah. Like, is there any carriers? Oh, I find, because then we go back to back in trading, you have the cheapest to deliver option, right? On the liner may not be as equivalent, right? Yeah. So they could potentially concept of cheapest to deliver option, which is, I'm going to figure the liner at that point, who's the cheapest or the easiest to secure, let's say Shanghai to Rotterdam. And as long as I fulfill that, it's okay, because this doesn't say anything about which shipping line, even what's the route it takes, right? Maybe the rotation is like super long, or doesn't really matter.
Or it can be any, and from the exchange side, find whatever line.
Just whatever, just fulfill that.
Want to match it. Yeah. But then, that would be, the cargo will be shipped. So that's what you mean by the fiscal settlement. But then the financial settlement means...
it's just a payment. Yeah, you don't know if you have a shipment or
not. What I agree on is in August of 2000. Yeah. But the freight rate becomes 3,000. So since I bought it, right? So actually get a profit of 1,000. Yeah. Yeah. Haven't shipped anything. I don't have shipping slot. But the advantage of it is, so when the market go up, I earn 1,000 just from my future trading. Instead of having 2,000 to get a slot, I get 3,000 to get a slot. Yes. Yes. And then the 3,000 is representing the going price in August. Yep. So I shouldn't have a problem getting a slot. Yep. Yep. Even though I don't get the fiscal slot, the financial settlement also financially enable you to get a slot without problem. So there's a different kind of settlement and the advantage and disadvantage. Yeah. But also worth thinking about in terms of product design, right? That's one major point I want to discuss a bit more here, is because in shipping, a lot of people really want a fiscal settlement. But for financial instrument, when you have a fiscal settlement, you won't have that much liquidity. Because a lot of speculators don't like to trade an instrument as a fiscally settled. Yeah. Because if I'm a hedge fund, you give me a shipping slot, and suddenly I need to look for cargo to go with it. That's true. But you just financial settle, I get the money right away. Yeah. Then you have a more speculator to come in. Yeah. When you have more speculator to come into the market, then in the industry, we get a liquidity for the application.
Yeah. And that's a very important point. It's a very important point.
So that's a point that I always have to experience about. If you want that, then you may not have a future market.
Because you're right. Because even for commodity trading, typically people also try to do physical settle rather than cash settle rather than physical settle. Because I think, if I recall correctly, even for oil trading, right, you have a situation where you have oil settling at a price less than zero, I think famously, I think there was a WTI settled less than zero in
just COVID.
It was the COVID.
2020.
Yeah. Because people is like, you still have a carrying cost. If I give you the oil, you have to store it somewhere, you have to move it. Therefore, you incur costs. Even at zero, you're still losing money. So you have to be paid to receive.
Yes.
And that's what people don't understand. That's the problem with physical settles sometimes.
Yes. So, but for fiscal settlements, that's one issue. So for freight railways, you have to think about freight rate as a perishable goods.
Yes.
Oil and other commodity, they are not. Yes. So if I am a trader,
that's true,
a financial trader, I end up with like 100 barrels of oil. Yeah. I can keep it.
Get with the tanker, I can store it somewhere.
But for shipping slot, the time frame for me to execute the fiscal operation is so demanding. I suddenly get a slot, and then in a few weeks I need to find a cargo.
Yeah.
But oil was my trade gone wrong. I end up sitting with 100 barrels of oil. I just need to find a warehouse or somewhere that I
can store it somewhere.
And then I can wait for when the price is good to my favor. Then I offload. But in shipping slot, the other thing about shipping slot is it's very different from other commodity in the sense that it's perishable. So today you don't use it, it's no good anymore. The ship sails, so then it's gone. So that the fiscal settlements are difficult.
It's a big deal.
It's hard to sell to the pure trader. But for a lot of other commodities, they do fiscal settlements because other traders, they find it easier to handle for cargo that they can store and keep.
I guess it's also normal if you have a procurement manager doing the trade or a shipping line, or maybe not shipping, a procurement manager, right? At the end of the day, his job is not just to do the financial thing. He's trying to fill his ship or to move some cargo. So it's very hard for him to justify that I made money by speculating, but actually I cannot fulfill my main job, which is to move cargo. So I think that's why for them it's a complicated thing to switch to.
But that bridge, that part that they find is unfulfilled just because they have not really think about, okay, with money, you get slot.
You get it, You pay enough, you pay enough, you get the price.
The problem with slot and freight rate usually is two problem of the one.
I agree.
So if you have price, you can pay, then you'll get it. So I think that financial settlement actually, it worked. Actually, I think we need to go that way to have a liquid market. So that we can use it with the financial compensation from the trading. You will get your cargo. If a shipping liner, you can go low, then you'll get cargo. If a cargo owner, you're willing to get high, your money to get high, then you'll get a slot.
So we've talked about the cash physical settlement. The other risk, I think, is the basis risk.
Yes.
Can you explain a bit what's the basis risk?
The basis really is for all these financial instruments, they will, depending on the fiscal markets, a fixed rate. For oil, then depending on the actual oil price being traded any given day, that's actually the settlement price. So it is the basis where how you settle. I mean, on what basis? On what order? I want to hedge a trans-Pacific shipment with, but now the only liquid market is Asia-Europe route. I try to use Asia-Europe to hedge trans-Pacific. Then you have two routes. Although over time they are correlated, but within a month, sometimes they can go either way. Then you have a huge basis risk because you are hedging apple to apple. Yes. And then the second one is the basis is that we talk about the freight rate in August, for example. But if you're underlining your instrument based on a benchmark freight rate, and that freight rate is actually based on quotation over time for the August departure. You don't really have a commonly accepted price for that week, for the point of time.
I think that's the problem with the not enough standardization, right? So if you trade something that's very standardized, it's very easy to figure that out. But because the shipping industry is so complex, and sometimes there's a lot of flexibility, or the other way to put it, there's always a cheapest to deliver option. You have many ways to fulfill the agreement. Then therefore, that's why it creates potentially a big risk.
One more issue is in our industry, it's actually not that transparent.
Yes, there's that also.
So that's why for the same week of vessels, sometimes you have all different quotation, and lots of people accepted it and ship on that rate that are being quoted. Some players do not like the transparency added by futures because they think that their business live on, they have information advantage. They think they can gain on it, but sometimes they could be loser as well.
I think it's a symmetric risk normally. It's symmetric. It's not just always one way.
Exactly. It's not always one way. Also, okay, the third thing, one, we talk about you're not apple to apple. Second one is, our basis price actually very wide, and the basis that used for the settlement may
be different,
not covering this range, or skew towards higher or lower end. And then you also have, even the basis correct, But then you use the average price may not be sufficient for you to get the slot sometimes because the range is wide. So that's being practiced in the industry. And then you also could have the issue about sometimes you don't use a company accepted format of a pricing. Like if I use a future product that's on index, and then in the market we use $1 per 40 footer. And then you also have this translation risk in the basis risk itself.
It's important to highlight all the problem potentially before we talk about the benefits. I think for a lot of people, they always worry. It's a bit like in the movie, I think it's The Big Short. For me, there's a scene where the guy's asking to do the trade, and the guy's asking, so how are you going to screw me? Explain to me how you're going to make money. And the guy explains, that's how I'm going to make money. Now I understand how you make money. I buy it, and therefore I want to trade. And I think that's very important when you trade a new product for financial thing. You need to understand all the risk. And if you understand how you potentially can lose money, how to control for that, then you can look at the benefits. Any transaction, they always risk. So, but as long as you understand the risk, then you can handle it. But I think there's two other risks I think we can talk about. One is the margin call. So I think for people who never done any trading, like what's margin call? And the second one is liquidity. Let's talk about margin call first.
The margins for futures, they allow the trader to trade a fraction of the value that you're actually trading. So like for fixed future, for example, usually for $100 worth of contract, so you only need to put in $18, so 18 meaning 18%, or $20, 20%. The margin change depending on, especially the one in China.
The volatility, or what's the rule?
Up to the exchange, because the exchange in China, they try to discourage speculation. So when they find the market too speculative, they increase the margin. So and then usually the effectives are like overnight. There's they also daily limit. Daily limit meaning the most instrument can move within the day. So the daily limit in China is around like 20%. So if you put in a margin, the fixed future move the daily limits, like let's say you long on a contract for $100, you put in $18. If the contract drops in daily limit 20%, meaning you lose 20%, $20. You have to put in the $2.
What if you don't put the money? What happens?
Oh, then you default.
So then what happens for the exchange when you default?
So the way a proper exchange work is they have this distribution of risk. So if a trader default, the broker need to step in to put in the $2. But then in China, I
think they just close the position, right? They just close the position for you, right?
Oh, but then you still need to fulfill the $2.
That's true. You still have to cover the
firstly, of course, you close
the position.
You default, then the position close. But the hairy thing is usually, if yesterday dropped 20%, is the likelihood is the next day when they open, will drop again, right? So it won't be you just lose $2. And then the most hairy situation is the second day could also be a limit down. Limit down meaning when the market open. So you're on the queue for your trade to be executed. Your trade may not be executed. Then you suffer another day with $20 loss. So firstly, the trader's position will be closed. The broker need to step in to fulfill it. So then you have a one layer of risk management. So the broker have a big enough balance, need to have big enough balance sheet to cover the risk. But then sometimes the trade is so big, so like this aluminum case that we heard about in 2020.
LME,
then multiple brokers could go bankrupt because that trader have account in multiple brokers. So then a domino effect. Then that's time that the exchange will need to step in. Then the exchange also need to have a balance sheet. But before the exchange step in, usually most of the exchange have this kind of insurance pool of money. So from all the brokers, so that money is used to put into to fulfill any potential hold. So basically close positions, layers of risk management or party to fall in to cover the hole, to allow so the beauty of this system is one is the opposite side will still get the trade done. So if you bought it, you default, the one who sold it eventually will still get his contract fulfilled. So that's what you mean by clearance. The exchange will create,
the clearance
will create, and then the money that is owned to the clearinghouse will be taken from the broker or not the broker, from the pool insurance money, if not from the exchange. So in the case of China, so maybe the government will need to step in. But the worst ones are what we've seen in the aluminium stories about. So the exchange step in and say, actually, in my room,
cancel the trade.
I have the right to cancel trade.
The trade didn't happen.
So the trade didn't happen.
Yes.
So that is the margin call is very hairy. So So that's why, so for the industry player, when they look at this instrument, what I suggest them is don't trade on margin. If you are going to trade $100 worth of contract,
just put 100 next to it.
You have $100 because in most of the company that we are speaking to, they're all big companies. Yeah. It won't work if as a line manager, I put in a trade with just margin money, and then another day I get margin call. I tell the company to get more, ask the treasury department or finance manager to get more cash. Their approval process and all this, so it won't work. So much better that because you hedge, right? You
don't need to take extra risk. You don't need to take.
You just try to match your risk in your fiscal side. So you just for $100 worth of a future contract have $100 ready. So then you don't need to worry about the cash flow. That's
And then the next one, I talk about liquidity.
Yeah, liquidity of course is important. So because without liquidity, like my story about Horizon. So if I short, I have a 100 million short position, and then that stock only trades $100,000 a day. So when I want to buy back my short every day, I will push up the price. My 100 million positions is in for liquidity for multiple billion. So then that liquidity allow me to just close my position. Liquidity also important in the sense that for knowing the price. Without liquidity, you don't even know what are the price in the market. So without liquidity, then you can only get a kind of imaginative price from the broker, and then the broker will need to look for a counterparty. When eventually the trade settles, the price may be hugely different from what you know. I would think out of all features, of course, the product design for future product, that's important. But then the liquidity is...
I agree. I think liquidity is the most important. And I think that's probably when you choose which feature to trade, that's probably the single biggest factor. But if there's no liquidity, there's nothing you can do. And then an example also I want you to give, I think we can discuss a bit more, is when people use the feature the wrong way. And which is very famous here, is the example of airline when they took the feature to do the wrong thing. An example, I think we can name them. Cathay Pacific, it's well known that they did the wrong thing. So can you share some, like, when you're a corporate and you use the feature the wrong way? One, why does it go wrong? And how did it go wrong for them?
As an airline, the case was hedging the fuel price. Fuel is your a cost element in your business model. So when the fuel go up, if your revenue doesn't change, so then of course you earn less money. So then you have all the interest in delivering your budgets by fixing the cost. I think that was the intention. In airlines, the cost move with the fuel price, but their revenue
would change also.
They also have a fuel surcharge element.
Yes.
Unlike shipping, in shipping, the fuel price and the freight are always bundled together. But airlines, since most of the airline customers are the individual, so they don't really bargain with you on the fuel surcharge. Usually when the fuel price go up, the airlines, tomorrow, because the fuel price increased by 10%, so then I will increase my revenue by like 5% to match the increment. So then the customer will take it. So they're just floating element in the revenue.
They naturally hedge. They hedge already.
But if you fix your cost by hedging the fuel, and then when the fuel price
goes down,
your revenue will also drop, then your margin squeeze here, and then your cost doesn't change because you fix it. That was one risk. So, but the advertised reason that they come out in the press about where these airlines eventually lose money is because during COVID, the flying volumes are much less, right? Like let's say I don't know the exact number. Let's say they hedge 1 million barrel of oil worth of oil. But then eventually because of COVID, no one travel. So then you overhedge then your consumption. So that the important thing that the 2 point learned from it is you have to think about your own margin, your business model. If what you hedge is really
a real risk.
So if your revenues are floating, you hedge your cost, then that's not a good idea. You're taking a one-sided bet basically. So, but then another point to learn is, the quantity, what you have. So usually in futures, we don't. So like let's say I'm a shipping company. I have like 20,000 TEU to Europe. I don't hedge 20,000. What if I don't carry 20,000? Or I don't really have them, like that capacity. So because I change deployment and so usually you hedge a portion. But most users for future, they don't hedge 100% of their business volume.
I think But okay, so I think we've done the 101 on futures. I think we can do more specifically on the freight futures. Although I think we talked from the angle of freight futures, right?
Yeah.
So first, let's talk about why there's a need for freight futures in this market. Let's start with this.
So I have been an analyst for 20 years. So, and most of the time, my job was trying to predict where the freight rate is heading. Because when I was a stock analyst, so the company's earning depending on the freight rates. And after all these years, my conclusion is that freight rate is not very predictable. But I mean, you need to know all the facts about what's moving it, so that at least you don't know less than your peers when making decision. But when you are taking some position or taking a lot of cargo as a forwarder, you have to accept the fact that it doesn't matter how smart you are. The second one is freight rate has been, for container freight rate, is always very volatile.
Yeah.
So back in the days before COVID, they swing between, it could be low 500, 800 US dollars for 40 footer, to 2,000 for 40 footer. So just the last few months, Pacific freight rate went from at the, I think, beginning of May, from 2,000 to 6,000 in a month.
Yeah.
So
and so the other thing is it a one way or it's like a up down? Because I think that also impacts the realized vol.
Slight up down, but mostly one way.
Mostly one way. Okay.
Yeah. So freight rate also quite trend sensitive in the sense that if it's a move up yesterday, the chance is very high chance the next day also move up.
Got it.
So 6,000 in 1st of June, now it's become 2,500 again. That's a 200% increase, and then it's a 50% drop.
Yeah.
And
the news is just the tariff, right? Tariff on off, and that's the main driver for the price right now.
We didn't say tariffs.
Yes.
The market crash, and then you take it out to the market. So from May rebound, because of tariff. So it's highly not predictable. So, and then the volatility increased since COVID. The increase mainly because during the COVID, the liners realized the customer can pay much higher freight rate.
I think we talk about what's important because the market is very volatile.
Yeah, volatile, unpredictable.
Yeah, unpredictable, volatile. Very good reason to do hedging. The second one, I think, how about market size? Is this something is the TAM sizable enough for people to care?
For liner shipping, the industry revenues, it range between about like $150 billion a year to the peak during COVID, close to 500 billion. But then in the industry, you have both buy and seller, right? So you double that revenue. And then for industries, maybe about 50% of shipments involve freight forwarder. Yeah. Then the freight forwarder, both buy and sell side. Again, So you can take whatever annual revenue of the industry multiplied by 3 times, basically, to just think about the market potential.
Just give folks a sense. Yeah. I think it's well known that digital marketing, which is the thing that funds Alphabet and Meta, now, is roughly 500 billion USD a year business. And so that powered these two Max 7 company.
Yes.
So what we're talking about size-wise on a yearly basis is really significant, right? It's a similar size, roughly.
Yes. Basically, whatever industry's revenue exposure is, you can give a multiple. But the eventual liquidity of people who actually trade it. So like oils, the actual future market in oil and a lot of other...
It's a multiple of actual...
it could be a multiple of it. It needs to be, otherwise it's hard for the industry application.
So describe a bit more about what's available before the freight future. I think the one you want to talk about is the one in Shanghai, right? So give folks a sense of what's available out there besides the one in Shanghai, because I think there's a long history of freight futures that didn't really take off. So let's talk about the one that didn't work first.
The earliest I know people tried to launch container freight futures in the first decade of millennium. So there were already some effort. And then the one that I know happened in around year 2010. That was on the heel of the dry bulk FFA worked pretty well. It started to take off, dry bulk and tanker, then the industry started to use it and get interesting in liquidity. So it became an industry of its own, the FFA market. And then in container size, Baltics have a product. The Baltic product is a FFA. Baltic Exchange is it used to be a marketplace that the ship owner and cargo owner go there to fix cargo or just even before the container exists, right? For power and tankers, the charter ships. And then eventually now it become an index maker, marketplace where the broker, buyer and seller, get the trade done. Now they are an index provider. They produce a Baltic index. They track the dry bulk and then the tanker. Then there's multiple exchange in this world.
CME is the one that trade most, right?
Yeah, CME, I think Singapore as well, SGX. So they provide the marketplace and also the clearing service. And then, the Baltics actually launched a product similar to their dry bulk FFA based on SCFI from Shanghai. So they use the Shanghai's index to create a product being traded outside of China.
I think Shanghai Shipping Exchange, right?
Yeah, Shanghai Shipping Exchange.
Who collates the information from all the carriers, different shipment out of Shanghai to Europe and to US. I think those are two main routes. And they publish the statistics on the, is it the daily basis or monthly basis?
Weekly.
Weekly basis. Weekly basis. And they give you a fixing, say this is actually the level, right?
Yes.
So Baltic, they refer the index that's calculated over there. Okay.
Yes. So in shipping, we have Baltic Exchange, Shanghai Shipping Exchange. Now we also have the New York Shipping Exchange. Right?
Oh yeah, NYSHEX.
So they are all now becoming an index maker. So they're not really a marketplace. Well, NYSHEX may be a booking platform.
I think Freightos has also an index, right? Freightos.
Yes, Freightos also. So then Freightos also a marketplace. So a marketplace, but they're not a marketplace for the futures. They're a marketplace for the physical shipment, booking, and quotation. And then they also produce an index. So Baltics use the Shanghai container freight index to issue their own container FFA. And it's a broker by the voice broker like ICAP, Clarks. They couldn't take off because there's zero liquidity. So, and then we also in year 2011, between year 2011 and year 2016, Shanghai actually had its first container freight future product. So that product was launched under the Shanghai Shipping Exchange. It's not just making index. So allow party to go there to trade derivative products, actually the future product. So trade on screen instead of through a broker. So, and then that market has a good enough liquidity in the sense that they have a couple tens of million a day US dollar being traded. So it's durable. But back then, that market, one, is not open for international user. So
Chinese.
The China COSCOs, those they don't want to get involved, so it's mainly speculator in the market. And then the second one is liquidity-wise, that one works. But then the product design have an issue. Their settlement price is based on both SCFI and also the trading price of the future market itself. Usually the future product, the underlying, when we talk about the basis risk, is the basis usually based on the actual physical market. Correct. Is independent on how the future trader trade.
Why did they link it to futures? Do you know why they made that? It's a weird decision, right? Okay.
Yeah, so it's I forget half or a portion of the settlement price based on the closing price of the future, and then another half based on the index.
Okay. That's really strange. So just for folks who want to understand the risk, is when you have something like this, it invites a lot of manipulation.
Exactly.
Because you can start to, I think, hit the bid if you want to push the thing down or buy up the thing at the closing, right? If you have something is easy to manipulate.
That's what happened, actually. So I think there was one case of obvious manipulation, and then the exchange had to go back to cancel trades.
Right. Okay.
And then suddenly the credibility is lost, right?
Yeah, of course.
So the other legitimate trader, they found,
why would I trust this?
You don't go by the books. I thought I'd take this risk and earn this money. Eventually don't show. So the market, it launched in 2011. It basically have a sharp drop in liquidity in 2012. So when we talk about public exchange, is you need to be in the capital market. So a public exchange is very heavily regulated. When we talk about the distribution risk, right, the broker and then the exchange, you cover the risk of the broker. So all these parties in a public exchange, the trader, the broker, the exchange, all are regulated. You have some entry barrier,
of course.
To be able to participate in the market. And then that when it's not on a proper exchange in Shanghai back then, they don't have the infrastructure.
So the risk management was poor.
Risk management is poor. A lot of institutions would not participate. When you don't have a lot of institutions, then your liquidity is not very sustainable.
Got it.
And then the third thing also important is a public exchange, you have a network of broker. the brokers is important because the broker not only they become your distribution network for the product. So when you have the future market work very well in China because the Shanghai Future Exchange, there are hundreds of brokers working for the exchange. Then you have 100 brokers, they issue research report. So, then you have a lot of knowledge, it's an unlearned trader to come in to learn the product, to start to trade. So it turned out...
Here is like, it's not a proper exchange, no liquidity, product itself is not designed correctly.
No.
Risk of manipulation.
Yeah.
Okay, so
that tool, one outside of China's, some user want to use it, but no liquidity. It's not digital trade. It's not easy for speculator to participate. And then the one in China, basically, and they went in the car crash at that time. And then now we come to the contemporary episodes. 20 fractals and Baltics join force together to produce an index. And the index is called
the
FBX. The fractals Baltics index. So that's they create a product list in SGX in Singapore and CME. But then because any products from Baltics, it cannot be digitally traded. Because the Baltic was owned by the brokers. You have to understand the history. When Baltic was sold to SGX, so for SGX to buy, you had to keep the product to be trade over the voice broker.
That's dumb.
So it's a pros and cons. Don't just...
No, the reason I say that is I did trading, electronic trading, right? And if you want to have high volume, electronic trading is the only way to go forward. It's obvious. But I agree, back to days, voice trading, because you have those larger than life brokers who can take big risk and they only do voice. But these days, if you force me to do voice, that's not the proper way to scale.
Right. So then that's the setup of sorts. But so far, they have some liquidity. I think they're getting a bit of traction. I know last year, some trade being put from the industry player. And then the product design is good. So this is the monthly contract. I mean, the underlying index price in dollar per FU, so some closer to the industry convention. So
they're doing things right. They do things right.
The product side, they have their advantage. And then, then the one in China is the one that launched in 2023. It's August.
So 2023 is in China, and then this year in 2025 is one the NiShares one that launched with ICE.
NiShares one, they haven't really talked about the futures launch schedule yet. They launched the index on the 1st of May.
And this one, so if they were to launch the future, it's going to be traded on ICE, right?
Yeah, ICE, yes.
Okay, got it.
Yeah, also I believe it will be digital trade because they haven't really...
I think it will be digital because ICE is huge and it's probably going to be, okay, got it.
So that's one. And then another one is Senator. So
Senator is going to launch also...
I think the news came out already.
Okay.
I just, it actually came out a couple of weeks ago. I didn't look into the details.
Okay.
I presume they actually, the announcement from
I guess you're right.
Euronext.
If you have some data about shipping rates, there's a natural play to create an index people to trade on. It's very normal, right? Some of those large entities, that's literally how they make money. Is taking the data and sell it for calculation. MSC is the one that gives you the index. Sorry, go ahead. So let's talk about the Shanghai one. The Shanghai one. Why do you think it's working better right now?
I would think the product size we would like it to be better. Okay. So the Shanghai ones they expire every other month. So in shipping, we usually make deals on volume commitments every week over a period of time. So if I can only cover every other month, it's difficult to use. They use index instead of dollar per FEU. So they have a conversion risk there, right? When we talk about the basis risk, and then the settlement price is based on the average of the last 3 weeks of a month. It's also inconvenient. Why it's not average of the whole month? My fiscal volume happened in the first week. They took a big spike in price. Usually the GFI,
the more
GTRI in the first week.
The more difference, GRI defined, general rate increase. The more you have a basis difference to the market practice, the more you create difficulty for hedging. How they solve that problem? How they get liquidity where the other people maybe don't have struggled to pump up the liquidity?
Well, once they digital trades, I think there's huge convenience for the random trader to come in the trade. Secondly, in China, they have a well-developed network of brokers and traders. So basically, you're opening a new game in an amusement park, and the amusement park is already a Disneyland. And obviously, your new game will have some people to play, right?
Yes.
If your whole park is only have this one game, you're not Disneyland. It's a bit harder to attract flow, right?
Yes.
So in China, they have that.
Our position more is a nightclub, and then basically it's like everybody wants to go to nightclub. Everybody's waiting in line outside right now. That's what's happening. Okay.
Yeah.
Got it.
So they already have that. And also in China, you also have to understand the way the market works in China is that the entry barrier for a regular trader to enter to the market to trade is very low. So outside of China, like in Hong Kong, either the exchange require or the brokers require that you have to be so-called a professional investor.
Yeah.
So professional investor, you have to have experience in trading. So because the broker had to offload the risk to you, your experience, and you ask for it. It's not like I'm selling it. Second is for professional investor, you need to have a $1 million liquid assets. So a lot of well-off people don't have a 1 million liquid assets sitting around. In China, they don't require that.
There's more people in China, and then the pool people can invest actually are much wider.
The eligible traders,
the pool is much bigger.
Much bigger. So they in China, because this kind of professional investor requirements is a kind of a risk management for markets outside of China to make sure the party actually have the liquidity. But in China, they don't care if you know or you have money.
I think there's probably another thing also, right? Is there are lack of other type of thing to trade in China also, right? So real estate is not doing very well. Stock market, at least until recently, Asia is not doing that well. So if you have something that moves, and then you can make money. I think naturally people, the Chinese are pretty big gamblers. That's also another a draw to it.
In China, they manage the risks in a different way. So the exchange know the position of every trader. Outside China, so the exchange will only know the position of the broker. The exchange would not know, like let's say.
I see.
Let's say I open an account in JP Morgan to trade stock and things. The exchange will only know JP Morgan holding so and so stock, but doesn't know who behind JP Morgan trading it.
And then it's linked to the ID of the person, right? So they know exactly who the person is.
Yeah, and the exchange also has the authority to call individual trader and say, hey, you have too much position, you have to close it. No, in China, they have full visibility.
That's the thing. Cannot exist in China.
Actually managing what risk they're allowed to take.
I understand.
So, and then they can directly close your position.
Can they close the position as well?
Oh yeah, they're instruction, not a recommendation. You don't think they do it for you.
I understand. Wow. So the exchange can close it. Okay.
Yeah, so
that's interesting. It's the first time I hear that. Okay, they can close my position against me.
Yeah, but then they have it in their rule book. So it's not like they do something outside their rule.
That's interesting because that's another way to design an exchange. Because I think it sounds crazy to me.
Yeah.
But I can also see the positive side of it, which is that there's no rogue traders that look like really stupid risk.
Yeah.
So that protects everyone to some degree.
Yeah, so far they don't really have the systematic, like the aluminum case. There's one particular trader, they open an account in multiple brokers and trading the same thing. And then they trade more than their own physical exposure. And then somehow the other traders know they're trading certain product that they don't have the physical exposure. And then everyone just sell it to them, and eventually that trader blow up. But in China, it won't happen because the exchange knows how much you have and then how much you're allowed to do. So that a lot of industry player in futures, they use example to showcase actually China is a risk management. I think we're better.
Got it.
So that's why it get a lot of liquidity.
It's not blowing up, and then the risk is good. Okay, so let's give folks a sense of the liquidity. What is the daily turnover?
The FIG future in China since 2023 August is 1.5 billion US a day.
1.5 billion
US,
That's massive.
That's on average. It's around 500,000 FEU of a container. So 500,000 FEU for only one route, Asia to North Europe.
If I don't look at future, if I look at the physical between all the carriers and moving goods, how many contracts they settle on a daily basis?
Oh, okay. So I will compare like this. So for the entire Asia-Europe route, the volume's around 8 million FEU.
8 million FEUs.
So one day they do 500,000 already in China.
Okay. So basically,
so they actually said that's talking about like 15 times.
So we don't have the same horizon lines issue that you had. Liquidity is enough in this situation. I think we've established.
Yeah.
Right now, you have an interesting.
Do you want to touch upon the difference in indexes?
Sure.
The underlying,
Yeah.
So in China, the Shanghai Shipping Exchange actually get the liners did this future based on this index called SCFIS, and then SCFIS different from the SCFI. SCFI is by a bunch of liners for the panel that provide input about what freight rate will move the cargo next week. So it's a bit of a forward-looking based on the freight rate that declared on the bill of lading that moved cargo last week. But they also get it from the inputs from liners and the forwarders. Then they verify against the ports or terminals manifest to make sure the data they get from the liners, from the panelists for this SFIS is the bill of lading number, vessel name, voyage, and then the freight rate. And then they'll cross-check these against the bill of lading in the manifest at the port. Make sure there's a real shipment, the period match, and then every quarter they will also cross-check with the liners to make sure the information they get is correct. Yeah.
So it sounds like to me, one is more like almost like a LIBOR. It's like I'm saying what I predict the number is, and I take an average. Sounds like we're right for manipulation. Right. The other one is actual measurement. This is what has actually happened. Transacted.
Yes.
Right.
So that was the intent, but then not to discredit the panelists. I mean, so far there's no reason for them to really play around too much.
To lie, you mean?
Yeah, because over time, very difficult to lie because you cannot be consistent.
Well
once you.
Okay, so I'm going to be slightly contrary to that, right? So the LIBOR scandal, when it happened, you know what happened, LIBOR scandal, right? At the beginning, it was designed this way. You have a panel of the bank in London, say what the LIBOR is. It was, it's fine. They don't have any incentive to lie. And 60 years later, when the LIBOR became so important, you move by 1 basis point, it's like a couple of millions on your books. Everybody started to lie, right? Yeah. So if the index is really successful and all the contracts on that, I'm sure that people will lie.
Oh,
it's just human nature.
I don't know, it's quite trendy in the industry to use an index link. Right? So the most index links actually link to SCF.
Okay. I'm not predicting you will lie, but if you design this way, I think this is indeed a risk. If it's purely a panel, not on actual transaction, that is a risk you're taking. That is definitely a risk. And LIBOR was the example that happened in it.
We can debate that.
No problem. So one is actual realized, and the other one is more panel to say what you predict the thing should be. Okay.
Yes. Got it. And then the Baltics and Frictos are based on the transaction happened on the Frictos platform. Right. And the Frictos platforms, from what I know, is a lot of forwarders, maybe not the big ones, the medium, small size forwarder coding there, and then lots of SME shippers actually getting a freight rate there. So that one also, I think, could be a representative of the actual FAK market. But the Senator one, we know the Senator model is open source. So a lot of parties fit them the contract information, but I don't know if they have sufficient FAK quotation though.
Got it.
Because what they get maybe by design a lot of contract. But I will let Senator to explain themselves.
Sure.
So, but then one thing also, I wish all the index provider to be super transparent about how they make index.
The methodology of the calculation.
Yeah, because sometimes it's just not so easy for us to research on the internet.
I think I have to comment to this, right? So yes, if you do a lot of physical settlement, this calculation is very important. I agree, because the base is huge, right? But if you do pure cash settle, it may not be as important as long as the methodology is consistent and the distribution is stay constant, because you're just trading the delta, right?
Yeah. So, but you're talking about just for the financial player. But if I'm an industry player,
physical,
price that the money that I made in the future market, I expect to use that price to actually fix my fiscal side anyhow. Correct. So that still need to be
correct. Correct.
Yeah, the basis risk is still there. And then for the nicest among all these indexes, nicest the younger index, right? Yep. So I think they also run on the model, getting the input from the liners.
Got it.
But I know Maersk and Hapag-Lloyd in the panels. I think they also try to do what the SCFI is doing, except that they use a dollar per FEU instead of turning it into an index. So those are the index, I think, it's important for the user to know before we move to.
Of course. So I think just before we started recording, you were describing to us also that the market is actually much more exciting than even a month ago. You guys actually seeing adoption, right? So can you talk a bit more who are doing what, who you were actually surprised that started to do this? And for each type of category, starting with freight forwarder, BCO, carriers, what is the benefit they're seeing today? What's driving those guys? And hedge funds, sorry, and also the speculator.
Okay, I'll let those parties to come out themselves eventually. I know the major liners in the very advanced stage of actually, because the value proposition too always for them.
Yes.
I look at them, it look like a working group. There's several companies in our conversation. So they put the finance or particularly treasury person and the line manager together to work on it. But they're very advanced stage. I think that they probably have done some trial already. So, and then from the hedge fund side, that they have done trade. I know at least two. So
what kind of size they've done?
Kind of, I think it's a trial, like 10 bucks per month, do it for the rest of the year.
Just to see how the settlement mechanism, how the index behaves.
Yeah.
Okay, got it.
I think they're just kind of running through the motion that they're at least involved orders. Yeah. But these are all big ones. So I think, although I think that the small and medium-sized forwarders and BCO, that the one who suffered the most of the volatility, because the big player they can also walk away from commitment. Yes. Right? That's the way they hedge. And I hope that the existing and future will change the culture, because eventually you basically offload the risk to the future market. Today's challenge, for example, forwarders. So often I get a bunch of cargo line already, but I don't really get sufficient slot from the liners. So I have to live on the FAK, right? So the spot quotation. But what if the spot quotations actually go even higher than what the price I promised to our customers? Then I'll make a loss. Or I simply cannot sell to our customers who want a fixed price I can only give floating. So oftentimes that's why the forward have agreement with a liner when the market changes, and then the BCO no show, and then they'll tell the liner that, I cannot pay for the slot, or you have to change it so that the price is low enough for me to get a spot shipment. So a lot of this kind of conflict happen just because they get cargo but no slot, or they get slot but no cargo. When they get the two physicals and the prices doesn't really work to their favor, so they cannot fulfill it.
So can I actually express it the other way for people to understand? There is this variable, which is a freight rate, which is super volatile that nobody controls, right? And everybody, BCO, freight forwarder, carriers, are forced to play this game. This is a way to remove this volatility, this uncertainty, as much as we can. You cannot remove completely, obviously, but to reduce it significantly such that it's easier for them to manage their operation, so they have more certainty. It's not for speculation. It's actually rather to have more predictability to what the number should be. Is that how to understand it?
Yes. So the future mainly take away the financial uncertainty. And of course, we also have operation uncertainty, right? Some production delayed, but at least you don't need to get out of the contract and the financial doesn't work to your favor. Because every time you enter into financial commitment, so when you take out that, of course, then it's much easier for the industry to fulfill their commitment.
So let me ask you a question this way then. So if, let's say, this thing were widely adopted by the industry, does that mean that suddenly the shipping lines are better investment? Because technically they're not as wild in terms of earnings, meaning the profitability is easier to manage. You can see the difference between a well-managed shipping line and a poorly managed shipping line, not purely on the operation, but also on how they manage this pricing risk. Is that correct way to think about it?
Okay, so first, ship investment for the shipping lines could be like 25 years, right? Which is the lifespan of the vessel. That's one. So another one's about a line manager, how they deliver what they budget. Just a year-on-year basis. For both, of course, now we don't have very long date futures, but I believe there's also another beauty of liquidity. When you have liquidity, then you can chop the contract out to much wider scope. So because then you have enough trader, right? So to trade even you
get them used to trade the front man, they will trade the long.
Then you have someone. I'm sure eventually, someone will offer some longer data contract. So although it may not I don't think it will go up to 25 years. But sometimes when we charter a vessel, I charter for 3 years. Eventually, you have future contract that cover 3-5 years. So as a players, a liner, charter vessel, I can actually cover all my slot in the future. So that's for a bit longer term. And then for the year to year, the stock market, sometimes what bugs me is earning guidance and the result actually doesn't really tie. It's not that accurate. Then, of course, the management in the year end and say, oh, we missed last year's guidance because of market volatility. Yeah. I'm sure there's the same reason this manager give to their board also. That means the board actually accepts it. But then when we have these futures, then when the shareholders know it, then we'll ask the line manager or the CEO, hey, so just you're telling me that this year in the fourth quarter you'll make losses or third quarter in your guidance. Yeah. Because now the guidance give out in March, right, usually. Yep. So we know that first quarter very profitable. Then you give a barely break-even earning guidance for the full year. Yeah. So your assumptions that the last 2 quarters will be loss-making. Yeah. Then, but then I look at the future price. Actually, all the price suggesting that you just short sell it in the future market, you will make profit. Yeah. So why do we give such a low guidance? So that's one. So the guidance, so sometimes you don't need to be so conservative. Yeah. So and you can lock in a lot of your future exposure. Yep. So in a profitable rate, so then it's also easier for the manager to deliver. Yep. So what we didn't mention, so through our organization here, is that the future market and the physical market, oftentimes they price differently. Yep. Although they eventually settled in the same price, yep. But during the course of the lifespan of our contract, yep. Sometimes the future market trader, they take a different view yep. from what we have in the physical market. Yep. For example, so in some months, we see that the futures offerings 3,000 for 2 months out, and then the market is offering just 2,000 yep. in the physical market. Yep. So from a line manager, it's much better to short sell future instead of tying my cargo with a cargo owner 2,000. So higher certainty, a better chance to get a better price. Yep. That's change for the certainty of earnings. So then it's you look more confident, right? Yeah. So we give a budget that get delivered. Yeah. So
let's say after this episode, some board member at Maersk, at MSC, at COSCO, they've watched it. They say this is a great idea. Johnson, that's a great idea. What's the next action they need to do in order to start to take advantage of this opportunity?
That's actually two angles I want to answer. One is actually quite important that the shareholders, the board actually need to know this instrument. They need to know this market exists.
So first they need to call you to do the training first to teach them the market.
Oh, we could. I mean, to walk them through the actual scenario about how to trade and all this. Hey, actually, that's another way to manage.
Your business is completely different.
Yeah. But your business could be managed in different ways to use this kind of instruments, and it's available now that wasn't available before. So that's we need to communicate. This message still need to go out. I think a lot of us in the industry, a lot of our peers in the industry, the stakeholder, the shareholders may not have heard of it. When they know it, then the good example that I could see is that the one that I've been speaking to is they really put a working group. So they think about in the organization who's suitable to do it. Yep. Put them together. So at least as someone who actually have experience in trading stocks.
Yeah, at least, yeah.
If a line manager never even trade stocks, chances are they won't be bothered to learn this kind of thing. Yeah. So one example I like to use is the steel industry in China. They're also very traditional. I mean, they're even more traditional than container shipping, and the SOE is more reluctant to do any changes. So, but over the last 10 years, I see that the steel industry actually they combine future trading and their daily operation, and then even their sitting plan change. Right. So you go to some of the commodities or steel mills or commodity trading house, line managers and the one who make the fiscal pricing and the one who actually manage the future book, they sit together.
Yes, they have
and then in between also have a risk manager. So then they constantly communicate with each other. Okay, so there's a lot of intelligence they can change, and also when they make decision, they make it together. Yeah. The last thing is you just have to try. You go through the motions. Don't do big, and then also don't do margins. Don't do more than your fiscal exposure.
I guess biggest difficulty thing is to start small. Don't go massive size at the beginning, and go through 1 or 2 cycles before you take to the maximum that you can.
good point here, 1 or 2 cycle, because different cycle, up cycle, down cycle, sometimes you may face different issue. So there's an element judgment, although for hedging, you don't need to really trust too much because you have a shipping slot and you naturally just short sell the future.
So we've talked in theory for quite a long time, right? So let's go to one typical example.
So the example I show here is for the liners.
Can I
just maybe?
Can you minimize this thing? It's here. Or is this one? Auto minimize. Oops. No.
Oh.
No. It's for the pen.
Liner have 2 options, right? So there's always a cargo, so customers that they're willing to give the cargo on a fixed price. But the issues about the price, right? If the customer give you a price, is that there's a loss making. But the price from the physical side is lower than the futures. Then for liners, I have a shipping slot, so my only action is to sell. So it's a matter of who I sell to. I sell to the future trader or sell to the physical guy. So if the physical guy give a good price, so then of course, so then get the fixed price, get the cargo, and then no need to worry about the future. But if the price from the physical side too low, then I may consider selling to the future. So the starting point is for the liner to pull the trigger. So I would do it only when the future. So for a higher price. Then the current scenario is I just take the current price for the August contract. So that's around 2,000. I used the Shanghai, then there's Asia-Europe route here. So we didn't talk about it. So the conversion of index to price.
The multiplier,
there's a conversion. But the conversion is not really a fixed 1.5 or 1.6 from index to dollar per FEU. So 2,000 index, the price around 3,000. So for August 3,000, then for the liners, you can actually take it and then earn this 3,000 regardless how the actual physical market price will turn out.
You can lock in the 3,000.
So customers think, August, so this year the peak season may also end earlier like last year. So they don't want to commit or they just want a very low price. So then you short sell the future, and then you tell the customers, I go with the floating rate, but to give you incentive, so to give me this commitment, I give you a discount. In August, whatever the future price is, 1,000, I give you $200 discount. So, and if it's a 4,000, I still give you the $200 discount. But then you actually, as a liner, you effectively lock in 3,000 minus a 2,000 discount. You actually earn 2,800, regardless of how the freight rate eventually go. So the upper scenarios, if the freight rate go up, so that is the opposite of what the customers want. The freight rate go to 4,000. So since you want an index link minus 200, then the customer will have to pay you 3,800. And then you will make lose as a liners because you short sell to the future market. So the 3,000. So you actually lost 1,000 because your price is 3,000 here. So you actually lost 1,000 to the future market. But then you earn more from the customers. Net, you actually earn 2,800. So just same as your original plan. And then here's in the spot market, if you go down to 2,000, then okay, so you make money because you short sell 3,000. The price go down, you earn 1,000. And then, but you earn less from the BCO as well. So your promise is whatever spot minus 200. So you, in this scenario, you get 1,800 from them. So same, however it goes, however it play out, so you will get 2,000. But the two different outcome is in here, you are the one who lose money. So the one who gain is the future market. Then of course you have an issue about if the BCO will show up, because he had to pay much higher fixed rate. So even if he doesn't fulfill it, he go to the spot market and look for other slot. His chances that he had to pay 4,000 instead of 3,800. So hopefully the 200 enough to lock him in. So and then of course as a liners, you lose optionality to earn 4,000. But then you earn the certainty, 2,000. So that's why I say, so when a liner to use a future, you like the scenario that you are actually using the future in the down market.
So basically,
because a loser in the down market is in the future market. The BCO will get benefit, you get benefit. The loser is the future market. So this one easier to execute.
So if I say it differently, right? So that scenario works really well when in early June, when the market went to 6,000, and you use that level to short sell.
Yeah.
That's the risk scenario. When it was at 2,000, you short sell. That's a bad scenario because if it goes up 6,000, the biggest risk you have is what if the BCO decide I'm not gonna honor my contract, and then you're stuck. You lose on the future side because you went up and you don't get a cargo. So in effect, what you're describing here right now is as long as the contract is still a bit iffy on the BCO side, you need to actually do when you think the rate is already high, right?
Effectively. That's one, or you really lock in the BCO.
But technically, if they come back,
you still have some buffer.
Yes, because you have 2,800 buffer.
Because you think about your costs, you lock in 2,800 as an income.
Yep.
The liners, the break-even levels, it could be just around like 1,700.
Correct.
So you have 1,000 buffers that you can
still play around with. And then the customer, technically, they feel really great because
they still buy lower than
spot. So technically, it's still a good trade for them. Right?
Yeah, still buy. Because the beginning of the premises is I already offer, but if the customer willing to pay me 3,000,
yes,
I'll take it already.
Yes, that's true.
Yeah, so but then the customer want much lower rate.
Yeah.
So at the same time, because the customer unable to commit in the future price level, you give them that. You think the market will go down to the index link.
So what I take away from this is I think there's still the biggest uncertainty still is would the BCO honor the contract or not, and that's why you were saying earlier one of the risk management perspective is to make sure that on the future side the future lose money and you're making money.
Yeah.
Then you lesser the risk of the BCO. But I think the way I read it also is if the arbitrage value is high enough, your cushion is enough to compensate you even if they don't honor it. That's
you get sufficient.
Right. If the cushion is very small to do this kind of thing, it's very dangerous. So I guess the other thing about it is if rate is low and people are not that willing to commit, still like if people want to walk away, play the game, don't use that as a hedging instrument. That's very bad. But if rate is very high and you have no way to lock people in, this is the right way to do it. Because very likely rate will go down, as we know in this market, right?
For liners wise, you have the whole ship of potentially few thousand TU slot right, for your allocation, and then like, let's say you pay it to lock in like a couple hundred or 500. You're sure you actually you can pair with some physical.
No, actually I don't read this way. I actually think even this scenario cannot make sense because. What happened is if the scenario happened again, right? You have very high rates, you cannot really lock in people. This is a way to lock in, it's risk-free, right? And then obviously the scenario where rate is very low going lower, this doesn't help, but that's always the bad scenario. The only thing you can do is blank selling and then try to take capacity away to prop up the rates. But future's not going to solve that problem, right?
No.
But at least in the good scenario, you have better control, better way to hedge it. And hopefully if people start to use this, you can also enforce people to follow the contract with BCO and make the market healthier. Right?
So let's do one more, maybe... So for BCOs, you have cargo, you have the buy slot. Your natural positions, you short in slot. So that's your starting point. So you have to neutralize it by buying slot, right? So you only buy from the future market when the future price is lower than the physical price.
Of course.
That's your starting point. So you see that the liner's quotation is much higher than what you see in the future market. Then you should long in the future market. So then tell the liners that okay, well, you should give me an index link in the slot side. So you get a committed slot finance for BCO to do it. Financially, you have less risk than the liner to do it. The liners are worried, the BCO will walk away. I don't have the cargo. But usually the BCO will get the liner will take your cargo as long as there's agreement. But it's just that the liner may roll your cargoes a couple of weeks. I take the example here is for October this year until April next year. So it's October year 2025 to April 26. So the average price around $2,000 for the footer. So then you buy 2,000. Then of course, one is the future price need to be lower than physical, but you also need to decide you really want to do that business.
Correct.
To distribute at all. Right? Let's say the 2,000 give you a profitable business, and this 2,000 also lower than what you get from the liner. Then you should actually long the future. Because by long the future, you basically lock in your cost at 2,000. So same scenarios, either the freight rate go up or down. Right? Let's say the freight rate in December becomes 3,500. So it's a surprise up cycle. So because you long in the future, entering at 2,000. So you actually make 1,500 when the fixed rate go up. So you make a profit in the future market. So, but then you have to pay higher fixed rate to the liner because you sign the index link.
Yep.
So the net plus 1,500 minus 3,500, you get 2,000. Just same as how you planned for. And then if the fixed rate go down, there's your long position in future. So you lose money in future. And then you pay lower fixed rate to the liner, so 1,500 then 2,000. So you add it together. Actually, sorry, this one's wrong. The slot cost is not 500 here, so I need to correct it. It's 2,000. So either way, it's 2,000 for fixed cost. So, but the two different scenario here is a BCO, when you want to long future, you like to long it when you have a higher conviction. It's upcycle.
Yep.
Because when it's upcycle, the losing end is in the future market.
Yep.
So, but then usually even the losing ends in the physical market, actually usually is that's not. You don't have the risk of the liner walking off.
I feel, so as you say, if the carrier doesn't move away, maximum they will just roll the thing next week, then it's not real risk. So my takeaway is this product, the BCO should do it.
Yeah.
No risk for you not to do it. Carriers, be careful. It depends on the situation. Level of the rates and what the expectation of rate will do is important as well.
Yeah, because the liner is a risk of the customer, not sure.
So that I think that's the nuances, right?
Yeah. So from this one, from the fixed forwarders, actually what I'm showing here is sort of arbitrary. Because fixed forwarder usually have both buy and sell side, unlike the liner. So fixed forwarder starting with a neutral in the slot. In this scenario, so forwarder can use future. So both either the future is higher than the physical or physical higher than the future. So in here, so the future is higher than the physical.
The forwarder should be buying me.
Yeah, the forwarder should buy from the liner at a fixed price and then short sell the future. If the liner quote the 2,400 and the future is 3,000, so then you lock in the 600 already. Then you can lock in. Then at the same time, you look for a shipper that willing to take the floating rate, and then you can give incentive to this shipper floating with a discount.
Yep.
So it doesn't matter wherever it go. So your math will still be the $200 profit.
What the two?
So for the forwarders, this kind of structure allow them to go for volume actually. Because a lot of time for forwarders, if the liner give a lot of slot, I don't feel I may have cargo to pay enough to take it. But if I know that I don't really take the financial exposure fully.
Because I can short sell it.
Yeah.
And if it's okay, got it.
Because for shipping, right? So even in a bad market, the ship will still be close to 90% forward. It's not like you don't have sufficient cargo. So if you are willing to go, so give away more of your gain as a forwarder, you'll get cargo.
So the way to think about it, it's actually going back to the forwarder being a broker and to manage the risk for the carrier, essentially, right? I'll take some more risk away from you, repackage it, figure out how to source the thing, and using this allows me to take less risk. As opposed in the past, I wouldn't be willing to do that because what if I get stuck with the extra volume I took away from you?
Oh, sure.
That's effectively what it is.
When the future market is mature, I will see a lot of forwarders coming as a counterparty.
Exactly.
Yeah, for both the cargo owner.
They affect your broker.
There's a lot of big fixed forwarders. They have their own treasury function.
Correct.
They issue option.
Yes.
Yeah.
That's what I was gonna say. I think if future really takes off, if you have option trading, and I don't expect shipping to trade option. I don't expect BCO to trade option. I expect totally the steady for forwarder, the German ones, to really start to trade options. Because it totally makes sense for them, right?
Yeah, totally. So for them, they can be all market neutral than today.
If I'm guessing, this market will be huge for option writing because the realized vol should be quite high. Therefore, a lot of people want to offload the risk. And as an option writer, actually be very, very juicy.
Yeah, we had to get down to a number though. So I just think for things that's very volatile, the option price also maybe not low enough.
To convince a buyer. But then I think it's move the strike, right? If you move the strike out of the money enough, there's always the people who would take it, right?
Yeah. And also because a lot of shippers, the cargo owner side, many of them don't have the treasury function or don't think that they can manage actually trading futures. They will be more inclined to buying option.
Yes.
Just buying insurance. Today, for a lot of cargo owners, the volatility of fixed rates is really a killer for them. So they can pay off all their profits from their 10% shipment profit margin.
So actually, let's compare to a financial market. The BCO are basically the retail guys. The freight forward become the market maker, option market maker, the market maker, option market, the Optiver, the SIG, and then the shipping line effectively are the natural. They manufacture these assets that exist, right? So they're
manufacturing the slot.
They're manufacturing the slot effectively. That's how to think about it.
Yes,
that's really interesting. The financialization of this industry, I think that could be very exciting, interesting area.
Yes. But what we talked about the pain point for shipping, so volatility, unpredictable freight rate, the major pain points about the level of commitment from those contracting parties.
Yeah.
For they cannot commit just because the freight rate volatile totally to their disadvantage. They can only walk out. But these instruments, in the long term, will help the industry to function more like the other industry. For other commodities, they don't have a buy and sell, easily walk out from deals. Yes, and then the credibility loss is so huge for them. But in shipping, just because walking out from contract just so being used so widely. So sometimes the party that actually commit these kind of things, they don't see it as a big credibility loss for them.
I think if this market becomes more widespread and use future to systematize the risk management to smooth down the risk, then you can sell more value-added services on top of it, because price is not a differentiating factor anymore. Therefore, next is services that you have to provide. As long as price and availability is the main driver, people will never pay for all those innovation that you want to do, right?
Yes, it is a game changer. Those are very old instrument in many other industries, but this will give container shipping innovation in a way because it's new to our industry.
I think we've spoken for many hours already. Let's close. First off, thank you so much for spending the time talking to us for so many hours. One thing I wanted to ask you, is there anybody that you recommend to speak next on the Schelling Point, and also why do you recommend this person?
I would recommend some of my former colleagues from Jefferies, other analysts, like this one, Leung. So he's a very vocal about the whole China model, the economies, how the Chinese products are being competitive, and how the current China's economy, he see a lot of opportunity. He calling China's GDP growth on the human capital front only, because a lot of people are very bearish about the shrinking in the population in China. But he expects a lot more productivity gain per person in China, just because the kind of education I think
that would be a very interesting thing, because absolutely right. One thing that drives the shipping is also the supply chain and how they're changing, right? And manufacturing in China and the total productive force in China is a very key input to that. So no, thank you. If you're willing to make the I'd love to talk to him.
Sure.
Okay. Well, thank you so much. Now, before we close, where can people find you if we convince the board member of some large shipping line they want to learn more about freight futures?
Right.
How can they contact you?
They can contact us by editor@linerlytica.com.
Okay, on linerlytica.com.
There's an email address, or go to our website to look at our contact and contact us directly.
And we'll make sure to share those slides. I think there's way more content in the slides that we discussed.
Yes.
And what I think, thank you very much today again. If you have any question, any feedback, feel free to share in the comment section. And again, see you next time on the Schelling Point, where idea will meet again.